Hey, welcome back. Since I started writing for Seeking Alpha, I got a chance to research significantly more companies than before. I like it because it not only allows me to dive into stocks that aren't as well known, but actually encourages me to do it. On YouTube, an undercover company also comes with not that much interest, and that hurts the entire channel, and it's not really worth doing it, and that's why you don't really see people actually doing it that often. However, since I got the community to a size I'm happy with, I don't really care about the views, and I'd rather discuss and present these companies for you than cover the same stuff everyone does just to grow the channel. I want to keep them short and not necessarily scheduled or something, because I can't force out a good idea every week, for example, but I want to share what I find with you. But that's enough of an intro, so let's get into them. Now, Amcor, this one is a packaging giant that recently bought B2Gold at a good price to become even better. They are a dividend aristocrat, paying about a 6% dividend and also wanting to do some 3, 4, 5% buybacks, and it's more of an 8, 10, 12% return stable type of investment. The financials are okay, although they'll have some debt to worry about next year, but they can always keep refinancing as it's pretty much normal. Although there isn't that much equity after the goodwill, they can make a ton of money. They expect 1.8 to 1.9 billion in free cash flow in fiscal 2026, so basically a ratio of around 10 to 11. Add some more synergies that they expect, and that's easily over 2 billion per year. They want to do some portfolio optimization, sell some business units, maybe repay some debt and do other acquisitions, and they should face the same opportunity as their clients. Don't expect this to be the next Nvidia or something, but maybe a quick 20, 30, 40% recovery thanks to rate cuts, and then a good and growing sustainable dividend and buybacks, so not bad. It's basically the same potential as Colgate, P&G and so on, but with double or even triple the dividend, so not bad to look into. Now, B2Gold, this one is nothing new, I talked about them before. They are a gold miner with operations in Mali and other countries, but most important, now also in Canada. A few months ago, the Goose mine started production, and at full capacity, that's about 300,000 ounces per year, meaning almost half of Agnico. If you put the same market cap per ounce as Agnico, that mine alone is worth more than the entire B2. Sure, it's maybe not the same quality, but even with a significant discount, that mine, which is about a quarter of the company's production, is worth much more than half of the current market cap. Plus a ton of other growth projects that are advancing significantly, and an overall healthy company with a good balance sheet and cash flow. Not to say that it barely moved when gold got to a new all-time high. Sure, Mali remains risky, and we saw what happened to Barrick, but the company is no longer just Mali, and at this price, Mali is basically coming as a bonus. At this price, this isn't even about gold, it's pure value with a good risk and reward in my opinion. Now, Vaalco Energy, this is an oil and gas company with operations predominantly in Africa and a bit in Canada. They had a couple of mergers and acquisitions in recent years and now have significant plans to develop. This year will be slower as they have to do some pauses to improve a project, but by 2027 they expect to more than double the production. Then, when the capex normalizes and the company makes 150 to 250 million in free cash flow based on my estimation on a 400 million market cap, the potential is really a multi-bagger. They barely got some debt now and still have a net cash position, but I expect them to get at least a couple 100 million more in debt to keep up with the capex. You know, lower oil prices plus lower production on like 300 million in capex this year will definitely result in a negative cash flow. Not to mention that since they are basically operating almost entirely in Africa, they had to get that debt at a 10.8% interest rate. And that's another important thing to remember. The company is exposed to massive political risk. The military juntas, even in the countries they operate, aren't the most stable form of government, and knowing that another one can rise to power overnight and even nationalize your project is something to keep in mind. But if everything goes according to plan, this company has potential to be a multi-bagger in just a couple of years. I calculated something like a 4 to 5x with normal oil prices, not some crazy upcycle with oil above 100. This multi-bagger is estimated based on oil at around 70 to 80. So a very high risk for a massive potential that I think you should look into and research. Now, Natural Resource Partners, LP, it's a limited partnership, so different dividends by the way. This one is a royalty company with a focus on US coal and an interest in one of the world's largest and lowest cost producers of natural soda ash. I talked about coal before, and there is a very important difference between thermal, which is the one targeted by all the green policies, and there is met coal or metallurgical coal used to make steel. The first is indeed probably dead in a couple of decades, but met coal is kind of irreplaceable at the moment, as I said in a previous analysis. What's interesting is that they target a fortress balance sheet next year as they repay the debt, after which they can pay massive dividends. To get an idea, a 75% payout on a relatively medium cash flow of 200 million is something like a 10-12% dividend, and they have enough capital to develop. They don't have to die together with coal, and who knows, in a decade maybe they'll have a ton of lithium properties, for example. And soda ash is an example of that diversification potential. This is the natural soda ash, not the synthetic one, which is much better for the environment and even cheaper. It's used in stuff like glass making, fertilizers, chemicals and so on, and even lithium carbonate for EVs, being tied to the economy. By the way, to join Seeking Alpha and get full access to all my research and countless other content, you can use the affiliate link below to get a discount and help the channel. Especially with a discount or even a Black Friday discount that should probably come soon, given how much I publish there, you basically pay less than 50 cents for an in-depth analysis and get about 2 a day, plus all the other content and data on top and the older analyses. And the value in that is much more than I can offer on YouTube because of the algorithm. Because again, as you are about to see, except for maybe one company, this isn't the stuff that you see covered everywhere. But yeah, the idea is that they use the massive coal upcycle to repay a ton of debt, freeing up massive cash flows and still have enough time to adapt and look for future-facing commodities while paying massive, even double-digit yields in the near future. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.